Hi everybody, David Kino with Basecamp Trading. This is the free video for Friday, February 27th. I want to highlight something that maybe you've not noticed because it's not an active security that we trade on a regular basis. And that would be specifically the intermediate term bond. I'm talking about anywhere from 7 to 10 years in duration. Now this is important, especially the 10-year specifically. The 10-year and specifically the 10-year yield controls a lot of the prevailing interest rates on car loans, mortgages, business loans. It's very, very important. And what we see is that those bonds have been clearly moving higher for a while now, since the very beginning of February. So here we are at the end of February. So you see the bonds have made a significant move higher. So therefore, the 10-year yield has made a significant move lower. So you can see prior to that, we were pretty much range bound anywhere between 41 and 43. Now this is an index, an ETF. So to get the actual equivalent yield on the 10-year, you just move the decimal point 1 point to the left. So here we were between 4.1 and 4.3%. Right now, today, we broke below the 4% level. Maybe you heard that mortgage interest rates, the average mortgage interest rate on a 30-year mortgage dropped below 6% yesterday. Well, the reason of that is because of this falling 10-year yield, and today we're moving even lower. So right now, the momentum's got it, and the yield is falling. That's something you really should keep in mind because this is achieving those lower interest rates that you keep hearing the president asking for. And he keeps yelling at the Federal Reserve. The Federal Reserve's not cutting interest rates, but the interest rates on loans are going down. This is actually doing it for the Federal Reserve because of the falling 10-year yield. Bonds are going higher, yield is going lower. So this is making borrowing cheaper. Okay? Thanks a lot.